Good evening. Welcome to this edition of India Tonight. I'm Vikram, and we've got a packed show tonight as well. So in the middle of the week, we've got these several questions to ask about the markets because, yes, we've seen a run-up. The bulls have taken complete charge of the markets, but there are certain quarters that believe that at least a few stocks, they've run up more than they deserve to, and there is a considerable amount of heating up in these markets. So how do new investors and how do investors who are looking at the run-up in these markets participate in the bull run if it is going to sustain? And there is an if to that as well. So that's a question we're going to ask our experts joining us on the show. We're also looking at one particular stock with all the action in the automotive universe. You're talking about two-wheelers, you're talking about this premium bike segment, and then of course there is Maruti's Invicto that's entered the market as well, on the back of which we have seen the stock zoom in trade today. It's reached a historic high. So then we're asking that question about Maruti and how much further it's likely to go, because the demand, is it as much as the supply is when it comes to premium offerings in the market, of which we have plenty. Also, as far as plastic money is concerned, a lot is likely to change if the draft circular of the Reserve Bank goes through. There is a lot to it and we will decode it for you. But first, let's get you up to speed with the headlines on India Tonight. Now, in today's trade in the markets, we are speaking about the Maruti stock, which crossed the 10,000 rupee mark intraday for the first time since December 2017. FMCG stocks have helped the Nifty eventually close around 19,400 today. All that action in the automotive world. Maruti venturing into the premium category again with the launch of the Invicto at just under 25 lakh rupees price tag. Bajaj, meanwhile, introducing Triumph Speed 400 and the Scrambler 400X. The RBI issues a draft circular on the issuance of credit, debit and prepaid cards. It says customers must an option to choose from the many card networks. Also, the RBI says that the banks must allow customers a choice at the time of issue or even the renewal of the card. Sources tell ET now that the much-awaited data protection bill has been approved by the cabinet today and it's now set to be tabled in the monsoon session of Parliament. Sharad Pawar says the party symbol will remain with his supporters, even as Ajit Pawar questions why his uncle is back from retirement. Both factions rally MLAs in a show of strength. Prices all around rising. Vegetables to spices, these prices are shooting up across the country this monsoon, just when the consumer inflation looked manageable. We're going to walk through the markets around the country and tell you where exactly things stand when it comes to these zooming prices. Our big story on India Tonight is about the markets which are hovering near life highs. There are several spaces, several pockets within the markets that seem pretty exuberant. There are certain stocks, in fact, trading much higher than their highest target on the street. So is there a question of overheating in these markets? Let's connect with my colleague from our research team. Shomit is joining us with the possibilities that exist of investing in these markets even as the bulls are charging. Shomit.
We have come out with this list from the Bloomberg terminal, and the filters that we have used is, firstly, there are at least 5 analyst recommendations on these companies, and all the share prices of these companies are trading above the highest target price that is there on the street. It is not the consensus target price, but the highest target price on the street. And we have come out with 7 names. Firstly on the list is New India. The share prices are trading nearly 12% higher compared to the highest target price, and this run-up on the share prices could be on the back of strong Q4 numbers, cheap valuations, but analysts continue to remain on the sidelines because they are expecting weak underwriting profits and higher expenses going forward. When it comes to GINTD, that stock is trading around 11% higher compared to its highest target price on the stress, and this could be on the back of government's strong push towards renewable energy, which could boost the new transmission capex cycle going ahead. But analysts continue to remain bearish on the stock because they're saying that the growth in orders and the margins are still factoring, that the street is factoring in is quite aggressive. When it comes to India Cement, it is a strong demand growth and lower petcoke prices, but analysts continue to remain on the sidelines because of lower price push, limited debt reduction visibility and poor ROEs of the company. When it comes to data pattern, it is the government's focus towards defense and domestic production that has led to the sharp run-up in the share prices. When it comes to Intellect Design Arena, now if you see strong deal wins, 30% revenue growth guidance and the buzz of a potential stake sale by promoter has led to this rise in the share prices. And when it comes to ICICI Securities, now the surge was recently seen when the company announced its delisting. Other than that, there is no other factor that could lead to such a boost in the share prices of the company. And lastly, when it comes to Torrent Power, it's overvalued and lower LNG prices which could curb trading gains have kept analysts on the sidelines, and they're still expecting the share prices to fall going ahead.
All right, so those are some of the stocks in focus. Shomit, many thanks for joining us. Let's break this down with our guests joining us, market experts both. Lakshmi Iyer is CEO of Kotak Investment Advisors, and joining us is Aditya Shah as well, the founder of Hercules Advisors. Great to have you both with us. Lakshmi, to you first. When the markets run up, they reach historic highs. There are some of us who are watching from the sidelines, not quite participating. You think of a young investor, perhaps earning anywhere between 25 and 30,000 rupees a month, never quite invested in the markets, and doesn't quite know what to do with this bull run that we talk about on a daily basis at this point in time. On ET Now, we certainly seem to be doing that, Lakshmi. So one option is always to take that SIP route into mutual funds. And I know you will say don't time the markets and all of that. But really, if one feels like running with the bulls right now, would you do it with stocks to build a portfolio?
Hi, Vikram. So, firstly, what really beats logic is that, people or investors are unhappy even when the markets are rallying because they don't know what to do next. And they're certainly unhappy when the markets are going down. So I think we are in that kind of a catch-22 situation where, when we talk to investors, when we're talking to clients, the thought process is, we love the India bull market story. But is there a chance that we invest now and we see the portfolio in the immediate red before probably turning into the green? Well, and the answer is, the stock markets are not going to be like man's heartbeat. It is going to fluctuate, but you have to have that longevity and make that investment right. Timing, obviously, your guess is as good as mine. And I very jovially tell people that you need to be either liar or extremely lucky to call the absolute tops and the absolute bottoms. So, with that in mind, I think even at the current juncture, a staggered way of investments, I know you will say it's SIP, but there is something known as STP, which is a systematic transfer plan, where you are actually distributing your money, say 100 rupees, into say next 5 or 6 installments, and not trying to get the absolute timing call right. Maybe you can accentuate it or enhance the pace if there is a price point correction in the markets. But looking at the broader picture, I think this is a better way to make sure that there is some amount of money which is definitely participating in the market even right now.
Yeah, you've always been bullish about the markets. You're hearing what Lakshmi is saying as well. But if you're building a portfolio, like my colleague Shomit was pointing out just a moment ago, he walked us through a list of stocks that perhaps have become too hot to handle. Would you agree that there are certain pockets in these markets that you need to stay away from, and perhaps the markets as a whole, when the bulls are charging as rapidly as they are, perhaps it makes sense to kind of wait it out a little bit?
Good evening, Vikram. So today is Mr. Rakesh Jhunjhunwala's birthday.
Yes.
And he famously once said that on the train from Bombay to Delhi for the bull market, we've just reached Borivali. So the point really is that India is not a story of today, tomorrow. It is a story of the next 10, 15, 20 years. So if you're able to invest in India for the next 10, 15, 20 years, you'll make a lot of money. Point number one. Point number two is market will go through phases of overvaluation and undervaluation. Every market goes through that phase. But the point really is that you have to have faith in the market, faith in the Indian economy, and then go on from there. Point number two. Point number three is India is seeing things that it never saw before. For example, manufacturing is coming into India like it has come never before. Today, we are hearing from the IT minister that by the end of 2024, you will start to see some manufacturing of semiconductor chips in India. It's the first time ever that this sort of manufacturing is coming into India. Apple is manufacturing big time into India. So the point is the economy is changing. So I always say India is not a dragon, it is an elephant. It changes slowly and steadily. And that slow and steady change ever since the last 5 years is now taking shape and slowly and steadily will start to move up. So we can debate here for many hours that if is the market overvalued or undervalued. But if I look at from a time horizon of the next 5, 7, 10 years, I can definitely say that India is going to do very well from here on. Having said that, in the near term, the market has rallied and there is a need to be very cautious. I will say that don't go out and venture in poor quality stocks. Invest in very high quality companies. They may not give you return for a short period of time, but you will find that your capital is safe there and keep investing in these high quality companies across sectors, diversify your portfolio, and you should be good to go. And as Lakshmi already said, an SIP or STP, any of those really work out, but try to spread out those investments. Market is no longer cheap. It was never cheap. It will never be cheap because the world is already taking a note of the phenomenon that India really is.
Talking about it, Aditya, there's no doubt about that. And you've always been very bullish about the long term. So when you say 5, 7, 10 years, there are those in the markets or looking at the markets that don't want to wait that long. At this point in time, when you look at IPOs, and primary markets are buzzing as well. But look at some of these IPOs that haven't done well. Lakshmi, what do you do when someone is suggested participating in an IPO, an LIC even for that matter, and it doesn't do as well as many would have imagined? That time, when you're seeing this kind of bull run in the markets, you do want to participate and be part of such IPOs. Would you do that at this stage, or would you kind of hold your horses there too?
The answer to that is not a cookie cutter approach of yes, I will do it or no, I will not do it. Well, the answer to that lies in the same principle as what really governs your decision making while investing in, say, the broader markets or in any particular stock, which is that of the business, the management, obviously, which is offering that IPO, and of course, the valuation. So it's a combination of all those three which need to be applied as a necessary filter. The way you evaluate it for a mutual fund investments via the fund route, or when you are doing a direct stock investment, whether it's an IPO or it's an existing stock. Honestly, if you see in this entire rally also, at the sector level also there have been laggards, at the stock level also there have been significant laggards. But does it mean that every laggard is necessarily a bad quality stock which will warrant an exit? The answer is no. So I think there is no carte blanche solution to this. One needs to clearly apply these filters, not get carried away by the excessive euphoria. I think that is the most important thing, because in times like these, it's very, very natural to get carried away. Just yesterday, I was tracking the greed and fear index, and of course this is related to the US index. It's gradually heading towards the greed territory, and one looks at the tech valuations in the US, it's clearly pointing towards. So I think keep all this in mind when you are evaluating an IPO, and just don't get carried away by the fad. That's very important.
Well, there are certain names within the stocks that seem like the ones to go with because their performance has been proven over a period of time, Aditya. And then there are these new age tech stocks, which, like Lakshmi says, creates a lot of euphoria in the markets. How do you go about actually picking and choosing what would be right for you, especially if you are a new investor?
Point number one is if you're a new investor and if you don't know how to analyze companies, straight away what you should do is go into an index fund. Index fund is a no-brainer investment where you don't need to think anything about it, or then get a mutual fund advisor who can help you go and invest into a mutual fund. See, investing in stocks is not very easy, and stocks are like your babies where you need to track and monitor them 24/7, which a normal office goer or normal work person cannot really do. So going direct equity is not a necessity. Mutual funds today are a great option for average retail investors. Those who really want to go into direct stocks, then there are advisors available out there. But for 90 to 95% of people, index funds or mutual funds do make sense. I will suggest make a portfolio of index funds together with active mutual funds and then try to monitor them and have your return expectations also very, very safe. To expect doubling of your stock portfolio every year is insane and should not be expected. If you expect a 10 to 12% return, that would be really great. So net use mutual funds, expect 10 to 12% return, and don't get overblown and try to go into a penny stock or poorly run companies. Try to invest in high quality companies. They may take time to give returns, but your capital will be safe. Lastly, I wanted to say this that the seeds for capital loss are primarily driven in a bull market, where in bull market every stock continues to go up and retail investors get driven to poor quality stocks. So this is the time to stay very cautious from poor quality companies.
And taking away from Aditya, Lakshmi, do tell us when it comes to certain themes, because essentially mutual funds also bring certain themes. But if you're looking for direct equity, a basic logic that you would apply is consumption. As a story, it would work in India. We are a domestic market that consumes a lot and will do in times to come. So FMCG, or you're talking about the auto universe, and over there we've seen Maruti run up so much today. Is it possible to choose at least thematically when you're getting into direct equity? Would you do that? Because you started out by saying that your guess is as good as mine, but certain basic theories can apply in times like this, and it does fall in the common sense category, wouldn't it?
Absolutely, but I would still maintain that thematic category. Some of them are quite cyclical. For example, commodities as a theme is cyclical, whereas FMCG can be slightly more long run. But again, there could be pockets of overvaluation. You would want to pay only that much for a particular consumption stock. Unless obviously there is margin expansion or there is volume growth. So therefore, as a thematic, one rule of the thumb which, as an investor you can follow is try to keep it as a peripheral or a complementary allocation to your frontline diversified equity portfolio. I think that's very important. Even when you are picking up stocks, see, because ultimately, if you look at the index, as a composition, for example, the highest component or the weightage actually goes to the BFSI sector, which itself is more than 1/3 of the portfolio of the index. And then you have, tails ranging from 10% to all the way up to 1.5%, 2%. So I think it's important that you cannot have one theme as an overwhelming part of your portfolio, whether it's through direct equities or through, because there is always a risk of a view going wrong. I mean, just imagine if I bought, the tech index a year back and you bought the banking, index a year back. Where are we today in terms of the mark to market, or for that matter, pharma versus the BFSI or the broader markets? So I think keep these as not as the core themes, but as ancillary themes. And as Aditya also rightly alluded to, if you are a DIY or a do-it-yourself investor who knows it all, who knows how to nurture these themes and take care of it and watch them grow, and that's your full-time activity, then go for all this. But for everything else, I think it's only worth your while to rely on the professional services.
Rely on professional services. Don't take calls to enter the markets when you're seeing everything move up and the euphoria build up. So don't necessarily buy into the euphoria if you don't have the time to study the markets and decide where exactly you want to park the money. Leave it to the experts. Aditya and Lakshmi, always a pleasure getting in your perspective, especially when the markets are on a high. And certainly, Lakshmi, we hope the happiness spreads when the markets are moving up, because generally there is cheer for the economy as well, because both are connected. We'll see how much heating there is in the markets, and that's something to be mindful of and cautious about. But thanks very much for joining us on India Tonight.